Whew. So, have you ever seen a company announce, these massive profits and then wondered, wait a minute, how much tax do they actually end up paying? It's a great question, and the answer is almost never what you think it is. Well, today we are going to pull back that curtain. We're going to take a company's financial statements, the numbers they show to the world, and walk through the entire journey, step by step, to figure out their final tax bill. We'll be using the Canadian system as our guide, so let's dive right in.
Okay, so here's our game plan for today. First, we'll look at the difference between accounting and tax income. Then, we'll get into the nitty-gritty of reconciling that income and calculating what's actually taxable. After that, we'll figure out the federal tax bill itself, look at some really important rules that guard deductions, and finally, we'll wrap it all up with the key takeaways you need to remember.
All right, let's start with the most fundamental concept. And honestly, this is something that surprises a lot of people. The profit number a company shows its investors is almost never the same number it shows the Canada Revenue Agency. Why is that? Well, it's because they are speaking two completely different languages, each with its own rulebook and its own goals.
So what's the deal with these two sets of rules? Think of it this way. Accounting income, which follows GAAP, is trying to paint an honest economic picture for investors. Its job is to answer questions like, is this company healthy? Is it actually making money? But tax income? That's a different beast entirely. It follows the Income Tax Act, and its goal is much, much narrower. It's not trying to tell a story. It's just a formula designed to figure out a precise number, the amount of tax owed to the government. It's all about legal definitions, not economic reality. And that, right there, is why this whole translation process is so critical.
Okay, so how do we actually do this translation? Where do we start? Well, the very first step is what we call reconciliation. We take that net income number right from the company's books and we start to adjust it, to shape it into something the tax law recognizes. The result of this first step is a number called net income for tax purposes.
And here's how that process works. It's actually pretty straightforward. You start with the accounting net income. Then you go through a list of specific additions and deductions that are laid out in the Income Tax Act. You're basically adding back expenses that aren't allowed for tax purposes and subtracting deductions that are allowed. Once you've done all that math, you land on your first major milestone, net income for tax purposes.
So, let's talk about those additions. What are we adding back in? Essentially, these are all the expenses that a company can legally deduct for accounting purposes, but that tax law says, nope, not so fast. A classic example is the income tax expense itself. I mean, it makes sense, right? You can't deduct your tax bill to lower your tax bill. Another big one is accounting amortization. We have to add that back in because the tax system has its own special way of doing things. And here's an interesting one, charitable donations. We add them back in this step only to deduct them later on. It sounds a little weird, but it's just part of the specific formula we have to follow. Now, for the other side of the coin, the deductions. These are things that the tax law does let you subtract. So remember how we added back accounting amortization? Well, here's where we deduct the tax version of it, which is called capital cost allowance, or CCA. We also deduct things like accounting gains on asset sales, because again, tax has its own rules for that. A really great example to show the difference is warranty expenses. For accounting, you estimate what you think you'll spend on warranties in the future. But the tax system, it's much more concrete. It only lets you deduct the actual cash you paid out for warranty claims this year. It's all about what actually happened, not what might happen.
Okay, let's make this real with an example. Meet ABC Company. They start with a nice round $100,000 in accounting net income. Now we start our reconciliation. First, the additions. We add back the $5,000 in amortization they claim for accounting, their $2,000 in donations, and a few other items. Then come the deductions. We subtract the $10,000 accounting gain because tax will handle that differently, and we subtract their capital cost allowance of $4,000. So you see what's happening. We're taking this starting number and chipping away at it, adding a bit here, taking away a bit there, all according to the tax rulebook. And when the dust settles, that initial $100,000 has been transformed into $99,000 of net income for tax purposes.
So we've got our net income for tax purposes. Awesome. But hold on. We're not quite ready to calculate the tax yet. Think of this as the final polishing step. We need to make a few more specific adjustments to get to the number that the tax rates will actually be applied to. This final figure is what we call taxable income.
And this final step involves some really important deductions. Hey, remember those charitable donations we added back earlier? Well, here's where they make their comeback. We get to deduct them now. But the really big one here is dividends received from other taxable Canadian corporations. This is a cornerstone of the tax system, and the logic is simple but powerful. That dividend money has already been taxed once inside the first corporation. So, by allowing the receiving corporation to deduct it, we prevent that same dollar of profit from getting taxed twice at the corporate level before it ever even reaches a person's hands. It's all about tax integration. And of course, this is also where companies can use losses from previous years to lower their income in a good year.
Let's go back to ABC Company. We left them with $99,000 in net income for tax purposes. Now for that final polish. We subtract their $2,000 in charitable donations, we subtract the $3,000 they received in dividends from another Canadian company, and look at this! They use a $5,000 capital loss they had from a previous year to completely offset a capital gain from this year. After all that, we have our final, most important number, $89,000. This is the taxable income. This is the number we've been working towards. It's the base that the whole tax calculation rests on.
All right, we've done the hard work. We have our taxable income of $89,000. So now what? Well, now comes the part everyone's been waiting for. We finally get to apply the federal tax rates and calculate the actual tax bill. This is what's officially known as Part 1 tax. Now, if you look at the basic federal rate, you might be a little shocked, 38%. But don't panic, the federal government immediately gives back 10% right off the top. This is called the federal abatement, and it's basically the Fed saying, hey, provinces, you need to collect taxes too, so we're leaving some room for you. This means the real starting point for the federal rate is 28%. But for a lot of Canadian businesses, the story doesn't end there. It can get much, much lower.
And to understand how it gets lower, you absolutely have to know this acronym, CCPC. It stands for Canadian Controlled Private Corporation. In simple terms, it's a private company that's Canadian and is controlled by Canadians. That's it. But getting this designation is like finding a golden ticket because the government has created some of its most powerful tax incentives specifically for CCPCs, all in an effort to boost small business in Canada.
And here it is, the main event, the Small Business Deduction, or SBD. This is a huge deal. It knocks an additional 19% off the tax rate. But it doesn't apply to all of a company's income. It only applies to a certain amount. And how do you figure out that amount? It's a simple test. You take the lesser of three things. First, the company's active business income, money it makes from actually doing its business. Second, its total taxable income that we just calculated. And third, the national business limit, which is currently $500,000. Whichever one of those three numbers is the lowest, that's the amount of income that gets the special low rate.
This example shows exactly how this plays out in the real world. A company's income effectively gets split into two different buckets. In the first bucket, you have the income that qualifies for the small business deduction. You can see that after all the reductions, the federal tax rate on this income is just 9%. That's incredibly low. Then, in the second bucket, you have all the other income. That income gets taxed at the general corporate rate, which is 15%. This two-tiered system is really the heart of small business taxation in Canada. It's designed to give a massive leg up to smaller active companies.
Now, whenever you have tax breaks this good, you can bet people are going to try to find ways to take advantage of them. That's just human nature. So the government has put in place what are called anti-avoidance rules. You can think of these as the guardrails of the tax system. Their whole job is to stop companies from playing games, creating artificial losses, or getting tax breaks that they don't really deserve.
Let's look at a classic example, the stop-loss rule. Check out this sequence of events. On day 1, a company buys a share for $10. On day 2, it gets a $1 dividend, which is tax-free. Now, because that dollar came out of the company, the share price naturally drops to $9. On day 3, the company sells the share for $9. Now let's step back. Economically, what happened? They spent 10 and they got 10 back. 1 in dividends, 9 in cash. They broke even. But on paper, they've just created a $1 capital loss. The stop-loss rule steps in and says, no way. That loss is denied because it wasn't a real economic loss, it was manufactured by the tax-free dividend.
And guess what? Even the super valuable small business deduction has its own set of guardrails. The government is very specific about who should get this benefit, so there are 2 major rules that can reduce or grind down that $500,000 limit. The first grind targets large corporations. Basically, once a company's capital gets over $10 million, its SBD limit starts to shrink. The second grind targets passive income. If a company starts making too much money from things like rent or investments instead of its main business, its SBD limit also starts to shrink. The government's message here couldn't be clearer. This tax break is for small, active businesses, period.
So here's how that size grind works in practice. The threshold is $10 million in taxable capital. This company here has $12 million, so they are $2 million over the line. The formula then kicks in, and for that $2 million excess, their SBD limit is reduced by $200,000. Just like that, their available room for the low tax rate drops from $500,000 down to $300,000, all because they crossed that size threshold.
Now, if you thought that was tough, check out the passive income rule. This one is way more aggressive. The threshold is only $50,000 in investment income. The second a company goes over that, their SBD limit starts to evaporate. And the formula is brutal. For every single dollar of investment income over the limit, they lose $5 of their business limit. So, in this case, the company earned $100,000 in passive income. That's $50,000 over the line. You multiply that by 5 and, bang, they lose a whopping $250,000 of their SBD limit. The government is not messing around here.
Whew! Okay, we've gone through a lot, from accounting rules to tax rules, from deductions to grinds. So after all of that, what are the big ideas you should walk away with? Let's boil it all down to a few key takeaways.
First, and most importantly, tax income is not the same as accounting profit. It's a legal calculation, plain and simple, designed to follow a specific set of rules. Second, the whole process, even though it looks complicated, is really just a logical translation, taking the language of business and converting it into the language of tax, one step at a time. And finally, things like the small business deduction aren't just random tax breaks. They are very deliberate tools used by the government to shape the economy and encourage certain activities, in this case, fostering small, active businesses in Canada. And that brings me to a final question for you to think about. If today's tax code is built to reward this kind of activity, what do you think the tax code of the future will prioritize? What behaviors will our government want to incentivize next? It's definitely something to chew on. Thank you so much for coming along on this deep dive with me.